Okay, let's talk about one of the homework problems that was dealing with issuing some stock transactions, issuing stock, treasury stock, that type. Let's look at the very first one where we're actually issuing some common stock. The problem says in April of 17, Fun City issued 11 million shares of stock, 11 million shares of common stock at a price of $10. Well, one of the things that helps when you're doing an entry like this is think about the entire entry. If you're issuing shares of stock, then you are collecting cash, right? So let's go ahead and highlight that. And this is 110 million. This is 11 million shares times $10, which is the market price. Of course, over here, we don't have anything about cash. We just have the stockholders' equity accounts. If you look here, immediately the 11 million shares that were issued, you will notice that the common stock here is $1 par. So immediately the 11 million shares times $1 is the credit to common stock. And that's this entry here, 11 million shares that were issued times par of $1. And then the paid in capital is very easy. You just come over here and it's, let's see, you issued it for $10 a share. Well, $1 of that is par, so the paid in capital, the part that's over and above par, is going to be anything over $1. Well, it's $10 per share, so you're $9 over par. $9 times 11 million gives you paid in capital. And this is, oops, this is, you've got the $10 per share. Oops. $10 per share, and it's what minus $1 of par is $9 per share times the 11 million shares that are being issued. So that gives us the total of 11 million. So now that you have your entry, it's pretty easy. Basically, they're asking you for this right here. Okay. Since they're asking you for this right here, what you can do is note that common stock will be credited for 11 million. That means it's going to go up. So 11 million. Then you'll also note that 99 million is going to be paid in capital. That's a credit as well. And because Pearson is super goofy, you'll notice it says up here, leave the box empty, do not enter a zero, except in the total equity column. So we leave this blank, don't put a zero. Leave this blank, don't put a zero, and you put here how much total equity has gone up, which is going to be the 11 plus the 99. You will notice that 99 plus 10 is 109, and one more is 110. Okay, let's look at the other one now. Okay, let's go ahead and do a stock dividend now. You will notice here that it says in June, the company declared and distributed a 10% dividend at a time when Fun City's common stock had a market value of $13. Again, the easiest way to tell what the effect is on stockholders' equity is to go ahead and make the accounting entry. So let's go over here and look how we would make this accounting entry. If you'll remember, when you issue stock dividends, it debits, it lowers retained earnings. We're not getting any cash, right? We're not issuing the stock for cash. We're actually just giving stock away and reducing our retained earnings. And our retained earnings is the 12 million plus the 11 million. Be careful. A common mistake in this problem is you forget. You look at the common stock shares outstanding and you just look at 12 million and you go, that's how much is outstanding. Remember that here you issued another 11 million. Right there, see 11 million? 11 times the $1 par. So you actually have more outstanding than just the 12. You've actually got outstanding the 23. So the 23 times the 10% stock dividend percentage times 13 is how much retained earnings is going to go down. Okay, we'll go ahead and put that here. $29.9. That's how much it'll go down. Retained earnings go down with the credit. And then we're going to have common stock of 2.3. That's 23 million shares outstanding. That's the 12 plus 11 times the 10% stock dividend times $1 par. Remember, all this stock is $1 par. So that's going to be common stock for 2.3, and that's a credit. We have more common stock outstanding. And then additional paid-in capital is the 23 million, again, the 12 plus the 11 times 0.10, which is the stock dividend percentage of outstanding shares. But it's not going to be 13 like in the first line. It's going to be 13 minus 1. The $1 par is the 2.3. $12 is what's left. That's the difference between 13 and 1. So you're trying to account for that difference between market value and what the stock certificate says on it, which is $1, and that's 12. And that gives you 27.6. And again, that's a credit. So again, you'll notice the key to this is knowing the accounting entry. A debit to retained earnings, a credit to common stock for the amount of the par times the shares outstanding times 0.10, and then the difference being taken to paid-in capital. Oh, almost forgot. You have to put the effect here on total equity. In this case, you'll notice that we're going up by 29.9. So 27.6 and 2.3 is 29.9. So stockholders' equity, common stock, paid-in capital goes up, retained earnings goes down. Obviously, nothing has really happened, so it's 0. Okay, let's do the next one. Okay, so now we're looking at treasury stock. You will notice here that it says in September, Fun City stock price dropped to $8 per share, so it's down from the previous $10, and it's down to $8, and the company said, hey, that's so cheap, let's buy 11 million shares in the market back up. So let's go ahead and remove $8 million of common stock outstanding out. Let's go ahead and buy it. So $8 times 11 million shares is 88 million. Here's the entry. We debit treasury stock for 88 million, which is $8 per share, which is what's out there in the marketplace, times the 11 million. And then, of course, a credit to cash, which cash, you'll notice, has nothing to do with here. We're not dealing with cash. We're dealing with exclusively the paid-in capital, the stockholders' equity. So really what we're left with is a deduction of 88 million. Remember, treasury stock is always deducted. So we come over here. On treasury stock, we put minus 88. And let me get this out of the way here. Notice that when we have treasury stock, when we purchase it, we credit cash, we debit treasury stock, and that lowers our stockholders' equity. Okay, let's do the next one. Okay, it gets pretty easy. We're kind of pushing downhill now because the next line is net income. So we just need to find out what net income is. It says for the year, they earned 24 million. Well, net income is always good news because it increases retained earnings and it increases total stockholders' equity. Remember that net income is when we close out all our revenue accounts. In other words, we bring them to 0 and take it to net income, and then we take all our expense accounts and take them to net income, and then net income gets taken to retained earnings because we want to have more revenues and expenses to get this to go up. So we have 24 million, check our math. Yeah, net income 24 million, that's good for retained earnings, and that's good for total stockholders' equity. Let's do the next one. Okay, let's look at declaring cash dividends. When we declare cash dividends, let's go to the accounting entry. That's the easy way to work this. Cash dividends means we're going to owe it. The only reason I'm not crediting cash and lowering cash is because you'll notice it says declared dividends. So when you declare dividends, you have a payable. You haven't paid them yet. That's the only reason we're not crediting cash. We will credit cash and debit dividends payable in the future and we pay it. But right now, we've declared dividends of 12 million, right? You'll notice the payable is a liability account, and it's nowhere in here in this analysis. But it does lower retained earnings. It lowers it by 12 million. So we put 12 million here. And you notice that we're actually going down, not up. And then, of course, that lowers stockholders' equity by the same amount. Notice, too, kind of an interplay here that net income makes retained earnings go up, and when you pay dividends, it makes retained earnings go down. Okay, last but not least, let's work the last part. Okay, to save some time, what I did was just go ahead and fill in the amounts for you. All I'm doing is kind of mechanically adding these down, and just add these down and bring the total down. Be careful here on retained earnings, you have some pluses and minuses. Of course, Treasury Stock's a deduction from stockholders' equity, so it fits in here. Be careful with putting together these amounts, because here it's telling you 25.3 plus 144.6, and then Treasury Stock of 88. Just be careful when you're running these totals. The reason I say that is you'll notice here that when you were inside this cube, you were putting negatives, right? Now here, again, because Pearson is weird, it's not making you put negative. It's letting you put the positive. So anyway, the totals here, you can't hardly see them, but they're 25.3, 144.6, 19.1, again, truing down 88 for a total of 101, which is what you have at the end of the period from 1 year to the next year. I hope this is useful. I just wanted to go over this. A couple of people that had some questions about it, and this is how you work. Basically, stock issuances, issuing of stock dividends, repurchasing of common stock, otherwise known as Treasury Stock, and then the good news of net income and paying dividends, which lowers retained earnings. I hope you found this useful.